Hello everyone, Stephen Furness here, Director of MGD Wealth and Chair of our Investment Committee efforts here at MGD. It's a pleasure today to be joined by Michele Santangelo, Co-Head of Asset Allocation at Quilla Consulting. Quilla is one of our long-term asset consulting and research partners here at MGD Wealth. Welcome, Michele.
Thanks very much, Stephen. Good to be here.
Now, for everyone, this is the November 2025 edition of our quarterly market update series, a series where we like to invite a range of our investment research partners to contribute and provide an update for our valued clients on all things economics and markets. So appreciate your time today, Michele. Just before we get started, a reminder, this is general advice information only, and any information or thoughts shared today should not be construed as personal financial advice. As always, we encourage our clients and listeners to seek personal financial advice, and the advisory team here at MGD Wealth is well placed to help you. Michele, we've got a few slides to go through that sort of give a backdrop to what's going on in the world, interest rates, economic growth, etc. So over the next few minutes, hopefully go through the major highlights of where we're at as we approach the end of 2025.
Yeah, absolutely. It's been quite an interesting year so far. Lots of good performance, but also a lot of volatility at the same time.
Yeah, and what's happening politically around the place, etc. So just a global economic growth slide there with sort of some where we've been in recent history through to where we think things are going over the next 12 to 18 months. Your thoughts on this?
Yeah, so I think from our perspective, we do anticipate a broader slowdown in global growth, and it's not going to be a collapse in growth, but certainly a slowdown to sort of below longer-term trend type of economic growth from the global economy. As you can see in the charts, we are expecting some slowdowns in most of the major economies going into the first quarter of 2026, but then there is some reacceleration as we start seeing the positive impacts of the fiscal policies and monetary policy easing coming through in those economies. Maybe just to point out that Australia, the trajectory looks a little bit better. However, we have had sort of a weaker base that we're coming off, and also that we are more sensitive to interest rates in our economy. So since the RBA has been cutting rates, that has also propped up some of the forward forecast for Australian growth.
Yes, and we're a day after Melbourne Cup, which means we're a day after the November rates decision. What did the RBA say yesterday about our growth, their view of our growth outlook?
I think the growth outlook is looking a little bit more suspect. I think especially considering that unemployment has ticked up. So we had that unemployment rate come through at 4.5%. The RBA had forecast a sort of a stable 4.3% over the next couple of years. So that does point out that we could have slightly lower growth than we were hoping for. And also maybe puts us in a little bit more pressure that we can't cut interest rates, given that we're also seeing some rising inflation. And that also might then put the handbrake on growth since we don't have that interest rate lever to pull.
Yeah, that was certainly the message from the governor at the press conference yesterday, I know. Interest rates, from a domestic point of view, obviously we didn't get a cut yesterday, and lots of different economists have got different views, but maybe some cuts coming mid next year. Is that your view, or it slow down the expectations of cuts?
Yeah, unfortunately, our chart wasn't updated for the recent market pricing moves. So this was updated last week, and at that point in time, we had around about one more interest rate cut from RBA pricing by the market. But revising that data today, we would be lucky to see one in the next 12 months. So
Right.
those interest rates cut expectations have really moderated, even in the short term. And I think one of the primary reasons is that spike in inflation that we've seen on the chart. Both the headline inflation number shot up to 3.5%, and even the quarterly trim mean, which is the more important inflation measure, also testing that 3% level, which is right at the top of the RBA's target band.
Yes, and inflation from services sector is I know you've got a note there on your slide, but I've been reading about that. It's creating an impact to the total CPI figure.
Yeah, that's right. So we're seeing a lot of some of those services components that were trending lower, things like inflation and insurance and dwelling prices, amongst others. Those have been trending quite low. They were very sticky over the last year or two, and now they've sort of bottomed out and are starting to trend up again, which is a concern. So yeah, some of those government run price increases as well are also running very hot. So I think broadly the underlying pressures that are coming through those inflation numbers more broadly are quite concerning. We got a lot more of the different components within the inflation buckets, all it's measuring above 3%. So I think it's a very broad-based inflationary pressure. We can't really pinpoint one specific aspect that's driving it more aggressively.
Yeah, so certainly a balancing act on for the Reserve Bank, no doubt. Interest rates in the US, they have been cutting recently, and they're certainly under political pressure to cut. Where are we up to there?
Yeah, that's right. Definitely under a bit of pressure to cut. So they cut in September and again in October. This is also sort of more contrary to where the inflation trajectory is on the chart. We've got where inflation is forecasted to head in the US. That's based on the personal consumption expenditure, which is the Federal Reserve's preferred measure of inflation. You can see that's starting to trend up, and it'll only start to maybe moderate in 2026. But the key factor or the key reason why the Fed is comfortable in cutting rates at the moment is that the fact that the labor market is looking a lot weaker. And that's pointed out in the falling payrolls in the bottom half of the chart. So that labor market really coming under pressure. Even the revisions that we saw earlier on in the year also were revised lower. So broadly, the Fed is balancing that weaker jobs market with potentially rising inflation. However, I think that they're of the point of view that the inflation we're seeing at the moment is more short term, driven by some of the tariffs that have been implemented. So those won't be a persistent upward pressure in prices, rather just a once off. That's just giving them more confidence to be able to cut rates.
Yeah, very good. I know there's lots more to the US Australian exchange rate than simply interest rates, but have you got a view over the next year or two on where that exchange rate is heading?
Sure. Calling the exchange rates was one of the hardest things to do. But I think from our perspective, we still think that the US dollar is still going to be structurally under pressure. And I think we'll probably see the Aussie dollar sort of trend a bit stronger. And that's our point of view. Hopefully we get to 68, maybe 70 cents. That's sort of where we think we should be closer to.
Yeah, it seems to be the expectation around the place. But yeah, with that growth sort of news, but then company earnings appear to be pretty strong, and the outlook continues to be strong.
Yeah, this is a very busy table, but I'll just highlight some key points that I wanted to mention. When we look at the 2026 and 2027 forward earnings growth across the different markets in the world, the earnings growth expectations are actually quite strong. So Australia would be 8.7% in 2026, 8.3% in 2027. The US market has been under a lot more scrutiny recently because of its exceptional performance and the potential for an AI bubble. But if we look at the earnings growth, that really is looking quite strong. So we got 12.9% from the S&P 500 next year, and another 11.2% the following year. And I think if you look at that broadly across the different regions, even the emerging markets, growth rates are all quite strong. And typically you won't have a big market pullback or prolonged market pullback when earnings are actually still looking quite strong. What else I wanted to point out was that looking at the valuation premium over the last 10 years. So if we look at the price to earnings ratio now using 2026's growth in earnings, we're actually probably not that too far off from historical valuations. So for example, the S&P 500 is only 5.1% above its 10-year average. If you take the equal weighted S&P 500, which takes out the effects of that Magnificent Seven group of stocks, US equities are actually about 12% undervalued compared to their 10-year average. So that puts the US market a little bit more in perspective. On the domestic front, though, the ASX 200 is about 13% more expensive than it has been over the last 10 years, which is a concern for us at the moment.
Yeah, maybe the banking sector is a big part of that potentially.
Yeah, absolutely. I think CBA has been one in focus for the entire year with a strong performance, but is one of the most expensive banks globally.
Yeah, absolutely. Oh, very good. So the final couple of slides are the upside for markets, and then there's a bear case slide coming up. So what are we looking at here, Michele?
So this is just showing the forward growth in terms of the S&P 500. On the chart, so revenue is sort of between that 6 to 7% range, while earnings is actually set to accelerate into next year. So in the third quarter of next year, we're expecting 16% earnings growth, and that's an accelerating base. And even if we go out to 2027, I think having 13 or 12% earnings growth is still particularly strong. So when we see those kind of earnings growth numbers, we think that the market does have enough momentum in it. And even though the latest earnings season that we're in the middle of has also been shown that more companies have beaten expectations. So we have seen a tick up in some of those forward guidances. One of the key drivers has been the capital expenditure from the hyperscalers, the likes of Amazon Web Services, Microsoft Azure, Google, etc. And they're even accelerating their capital expenditure. And I think the number is nearly half of the GDP growth in the US has come from all the expenditure, the cumulative expenditure from all this artificial intelligence investment. And that's not just from the hyperscalers, everybody who's helping facilitate the growth of the industry, whether it's through data centers, through energy production, all those kind of things all put together have really bolstered the US economy. And that's despite some of the weaknesses we've seen in other sectors.
Yeah, there's certainly a huge amount of investment. Yeah, as you say, across a range of different participants in that market. On the flip side, what are you worried about?
So on the flip side, yeah, I think the main concern is that we are seeing a broader economic slowdown. And the chart on the left shows the Institute of Supply Chain Management's manufacturing and services surveys, and you can see that's just trending weaker. But at the same point in time, which it shows on the bottom chart, is the prices paid in those surveys has also been trending higher. And I hate to say the word, and markets hate hearing it, but that's sort of a stagflationary environment where you're having weakening growth and a rising inflation. And that's sort of the negative aspect that we do need to be cognizant of, that if that continues and maybe the AI story slows down a bit at the same point in time, that can derail some of the growth outlook that we might have. Probably one of the other aspects we do need to keep a close eye on going forward in this bear case is I mentioned the valuations not looking that stretched, but there's also quite high expectations. And if we see those expectations not being met, that's when we can see a repricing in the markets, and all of a sudden we could see some weakness in equities as growth rates are repriced.
Yeah, it's not hard to imagine that happening. And so, in summary, your sort of views across various investment sectors.
Yeah. So just some summary views would be that in terms of the fixed income space, we do prefer Australian credit over government bonds, and in the bond space, we do prefer Australian bonds to global bonds at the moment. And then probably on the equity side, I mentioned that the Australian market is probably on the higher end of valuations, and so we still have an overweight to global equities versus Australian. At the same point in time, some of the alternative areas of the market, like private assets, mainly private equity, we do have a positive view on. We're starting to see more M&A activity happening, more IPOs coming to market, which is positive. And then everybody's been talking about gold more recently and the incredible run it has. We still like gold. Probably we would look to rebalance and take some profits at the moment, given that we've seen so much retail participation come into the market with lots of exuberance. So we would look to maybe buy only on some weakness again, but maybe trimming at current levels.
Yeah, and I do note on that, and obviously you Quilla helps us with the portfolio implementation. I do note on that global equity side of things, it's underweight US where possible, a positive view on emerging markets, and good quality small and mid cap equity exposure. So a nuanced exposure to global equities rather than an index approach. Fair to say?
Yeah, that's right. I think if we just look at the index approach, you would be very overweight the US, which we do have some concerns about, but are happy to participate in the strong growth there for the moment. But we do feel that a more diversified approach does make a lot of sense in the current market environment, especially when there's a lot more political and trade instability stemming from the US. It's pretty good to be exposed to other areas of the world where there still are really good companies and still decent growth coming out of them.
Oh, very good. Well, that's a good overview, Michele. Appreciate your time today, and obviously as an ongoing relationship and with Quilla and MGD Wealth, we look forward to that relationship growing and your oversight of client investment portfolios. So thanks for your time today, and we'll chat again soon.
Thanks very much, Stephen.